Alright, YouTube, welcome back to Stocks by the Numbers. Today I wanted to take a quick look here at Shopify, ticker symbol SHOP, listed here on the New York Stock Exchange. Company's taking a 5% hit today, down now sub $50, down $2.64 here on the day. And in my opinion, I actually think it's going to go lower, believe it or not. Now, Shop is something, if we pull up a one-year chart here, this is a company that, the hell do they do again? Yeah, cloud-based commerce platform. Okay, fine. So as you see here, they had their split 10-for-1 going all the way back to mid of 22, and then since then we had this big gap up. I drew out the line here, and I was talking about this rising wedge. I mentioned this months ago, actually, probably in the Discord, because when I searched across my channel, I didn't see a video on Shop, so I may have just mentioned it in the Discord, but you know, again, this is what I'm talking about. This is why I was so confident when calling out these newer age tech stocks that everyone just took to the moon really for no reason. And we're seeing it across the board here. You know, I recently called out puts on Spotify, which in my opinion is also too high. I was preaching for months about Airbnb stock being way too high. You know, and now we're seeing some of these names begin to sell off, and a lot of people, again, really don't understand why. And again, I have to go back to what I always tell you guys, which is the fact that if a stock is already way too overinflated and overvalued, even if a beat comes out, it could negatively affect the price of the stock, even with the beat. But anyway, you know, we had our rising wedge here. We approach the apex. We break. And then right here again, you can see, look, they beat earnings and then the stock broke down out of the wedge. That's what I mean. Sometimes when the technicals line up along with overinflated fundamentals, it really doesn't matter what the company reports because the stock's going to go down. Then over here throughout the tail end of August, I believe, you know, I don't even remember what happened. Maybe people raised their price targets or something. I don't know. They went into a new marketplace or something. I don't remember, but I just remember laughing my ass off that this stock drops down to, you know, the low 50s and then immediately rallies back up to, 67.60, as you see, top of the screen. The O, the H, the L, the C, the open, the high, the low, the close. You can see the high right there. 67.60 from 51.20 to 67.50, right? It took about a week and a half or whatever the hell it was. And obviously now, you know, a lot of people would have maybe said something like, oh, see, I knew I shouldn't have listened to you, blah, blah, blah. But like I always say, if it's really supposed to be up at this level, it would have maintained this level. And as you see, immediately, just a couple of weeks after, it completely gave it all back and even went lower than where it was before the fake pump rally. Now you see a little climb up here, a rejection off the 20-day moving average, and now we are just completely breaking down. We are now below my price target point that I initially called out here. Obviously, immediately in the moment, I was correct. And then, of course, we had the pop. But overall, again, the stock is significantly lower than where it was when I first started looking at the company. Again, about mid-60s, high 60s. Now the stock is sub 50. So, in my opinion, it is just overvalued and probably going to drop another 10% maybe here to this fib level here. This looks like a key level over here, and it looks like a top right there. So, right about there, 44.5, 44.60, right? It's about another 10% drop from today also. So, you know, unfortunately, you know, the timing may be a little bit off if you're watching this video now. So, you know, the stock could go lower, but it's already down 5%. And an old rule I used to follow is that if I wanted to buy puts on a stock, right, with it down 5% now, all the puts are now more valuable, right? They all increased in value because the stock went down. So I would try to wait for a day where the stock would have like a 1.5%, 2.5% pop or something like that. And then when the stock is up, that's when you buy the puts for cheaper. And, you know, vice versa. If you wanted to buy calls because you think a stock is going to go higher, you know, a day like today, the stock takes a 4 or 5% hit. Now is the time that we buy calls because we're getting them even cheaper than we could have yesterday. As you see here, even recent news, you got Citi lowering price target. That's a big drop from 77 to 62. And even UBS, look, going to 55 from 65, right? It makes me laugh that, like I'm screaming from a mountaintop that these stocks are overvalued. All of these analysts, they don't want to say anything. They want to keep increasing their price targets. They want to make it like everything's A-okay and the stock can only go up. Then when the stock actually begins to drop down, like yours truly knew would happen from day one, right? Now that the stock begins to tank and it's approaching $50, all of a sudden, oh no, it's not going to 70, it's going to 60. Oh no, it's not going to 65, it's going to 50, right? All of a sudden now with this stock coming down, they're saying it's going to go lower than what they first anticipated. That's why I'm telling you, man, there's really only a handful of jobs where you can be completely blatantly incorrect and still make money. I said this last time. You can either be a financial analyst. Apparently, they can be completely wrong, come back later, lower their price targets by 30, 40, 50%, and they still get paid. They still get their year-end bonuses. And, of course, the other occupation that immediately comes to mind is meteorologist. The only person who can say, oh, it's going to snow, and then it's 50 and sunny, but they still get paid. So that's why, it really makes me laugh sometimes, and that's why I consistently say my mantra to myself, which is, I know what I know. And what I know is that, a third-party e-commerce online retailer or whatever the hell this company does, they're not worth $64 billion. And remember, the stock was up to the high 60s. So now with the stock at 49.5, the market cap is $63.5 billion, right? So this was 70, 80 billion up here. The company losing over $1.50 per share, even though profitability has been increasing over the last 4 quarters. I can't completely knock them. And if we look annually, we can see we started out at about $1 billion in revenue roughly 5 years ago. Now, as of last year, the company did over $5.5 billion in revenue. That is absolutely phenomenal growth. And this is why I can appreciate the fact that they consistently brought this stock up quarter over quarter and year over year. But now, apparently, they had their best year on record here in 22, and of course the company took a big hit on the income side, as you see, losing about $3.5 billion. And if we switch over here quarterly, you can see we're kind of bouncing around. We got up to like this 1.7 mark from like the 1.3, 1.4 level, and then we dropped immediately back down to 1.5. Then it tries to retest 1.7, but look, as revenue went up, profitability went down. And even here as well. Revenue jumped up from 137 up to north of 17 billion, but profitability went down. So now that's what I mean. Now we're dealing with another situation. This is similar to what was the other stock? Spotify. This is similar to Spotify. This is what I was talking about the other day. It's if you look at the chart, it's like the more money they make, the more money they lose, which really doesn't make business sense at all. So obviously, you have some sort of leaky valve somewhere that has to be tightened, and someone's not doing their job. But at the end of the day, I appreciate the fact they really are growing the revenue year over year. I can't take it away from them. However, $5.5 billion for the year with the $63.5 billion market cap. This is what I'm talking about, right? This is what I'm talking about. There has to be some sort of financial fundamental rule that blankets all stocks and they perform accordingly. And what do I mean by that? Well, what I mean is Goodyear Tire brought in $20 billion for the year, and it has a market cap right now of about $3.5 billion, right? So we can't just say, oh, a stock should be trading 10 or 12 times yearly revenue. You can't do that, because then Goodyear Tire would be like $400 a share or whatever the hell it works out to. So that's why we need some sort of rules, right? And that's why I say my rule should be, even if the company is growing very, very well, if you want to trade it maybe at like a 4, 4.5, 5 times multiplier of annual revenue, understandable, especially if not only revenue, but also profitability is increasing consistently quarter over quarter, year over year. And that's why right now you're dealing with a situation where what? The stock is, after being down, mind you, stock was $70. Now it's at $49.5. And it's still trading like 12 times last year's revenue. So this is what I'm talking about. This is the problem with these new age stocks, because everyone just takes them to the moon. They jump in. it's a tech company that they might use the service of or they're familiar with, so they just say, oh, I'm just going to buy this because it's probably going to go up. You really, really can't think like that. And I'm sure there might be a lot of people watching this video now who own this stock at $60, $65, $70 a share, and now you're kind of screwed. Because in my opinion, this can easily drop. Again, like I said, this fib level here, 44.60, this can easily drop here to 40. No problem. That would be a 20% drop, which would bring the market cap, down to like 50 billion, which means you'd still be trading like 8-9 times the annual revenue. I mean, that's still overinflated down here at $40. So this is why I look for situations like this, because again, you may have these weird random pops when they decide, that some BS positive catalyst is adding enough fuel to the fire to justify a massive explosion. But again, going from 50 to 67 on some BS news and then immediately giving it back and going even lower than where it was before the news. I mean, that's what I mean. This is why I mentioned simple logic and common sense, right? Your mind should start to put things like this together. And again, it was down here at 51 and change. They run it up to 67. Couldn't even tell you why. It really doesn't even matter what the catalyst was. And then they immediately crash it back down to sub 51. Try to get it back above the moving average. Now it is sub 50, so it is making lower lows and lower highs, which means that technically the stock should continue to go lower. Now, I appreciate the fact that earnings are coming up, and again, 14.5 on the EPS side. I do see the profitability growing. I can appreciate that. Estimates of 167 billion, and last quarter you can see if they maintain that business, they might have a very good chance of coming in above those expectations. Look at that, nice 1.7 billion quarter. So the company, chances are, is going to beat earnings. However, in my opinion, again, even if they post 2 billion in revenue on 167 estimates, chances are the stock should be going lower. So this is, unfortunately, this falls into the category, as you see here with this random fake pop. This is what I personally label as a fake overinflated tech stock. And these could be very, very dangerous, especially, unfortunately, I have to say, again, I have to bring politics into it, with a Democratic president behind the steering wheel. This is a dangerous situation, right? Because in my heart of hearts, I basically know, in my opinion, and I believe that this stock is going to drop at least another 10 or 20%. Easily. However, again, the one sector that performs the best under Democrats, especially if you go back, even the last 15, 20 years, the best sector was tech. And this is what grinded my gears after elections in 2020, because I knew that when they put that guy Biden in, it was going to completely throw a wrench in the entire well-oiled machine that we had rocking and rolling from 2016 to 2020. And again, now they pumped up the tech too much, so now it's beginning to sell off and come back down to earth. But of course, they had to fake pump it for the first 2-3 years that this guy was in office. And I mentioned a while back, I know I mention it in passing sometimes, I go off on tangents in some of these videos, and I do apologize that I might not have your ideal structure that you would like it. However, again, like I say, I know what I know. I have a lot of experience. I was Series 7, Series 63 licensed financial advisor. I was trading for several years, and that's why I always say I know what I know. And even when they pump a stock up like this, I know it's going to come down. And same thing with the NASDAQ. When they had that entire massive pump rally throughout the summer, I was just sitting there waiting for the breaks, knowing that everything was going to start tanking down. And unfortunately, that's what we're seeing here. So it's really crazy, because if you do go back again, even when Obama got in 2008, he basically got in. We had that whole financial situation. We had to do, the bailout. And then, people forget that markets consistently rose, and they want to give Obama credit for it. And, I'm not really here to start bashing politicians, but I'm just talking about, how the market and money works. And basically what happened was people forget that there was quantitative easing, the QE, which people forget about. And basically, regardless of what the market was doing, at 3 o'clock, that's when the Fed would basically step in and start accumulating. And every day from 3 to 4, like clockwork, we would have a random rally. So even though a lot of other positions may have been getting smacked up, if you simply stepped in and bought index calls at 3 o'clock, you would have made money almost guaranteed about 90-95% of the time easily. But my point is, if you go back, right, I want you guys to look, go check out the sectors, and what you're going to see is, they climbed everything up and rebounded the whole market, and then if you look, everything kind of flattened out. And it was really unfortunate because, like, a lot of brand name American companies began to take hits, they began to sell off. And the only sector that really was, the lone shining star there was the tech sector. That was the only sector that really got rewarded. If you go back and you check it out, I'm telling you, it was the tech sector that really got rewarded. And unfortunately, we're kind of seeing the same exact strategy now taking place. If you pull up, some of these material stocks have been struggling as of late, right? Especially if you look at something like Alcoa. Alcoa was doing very well before 2020. And now if you look for the last several years, it's been falling off the cliff. So the stock was north of 60, 70 a share. Now it's down to like 20 and change, right? So that's what I mean. Like our American companies, our material stocks, like all of these are taking hits. And the one sector that was rewarded, minus the last couple of months, was tech. That's why everyone and their brother in every Discord you go into, they're all talking about companies like this. Shopify, Spotify, Airbnb, or, people just trade Tesla every day. Shout out to the guys in the Discord, because when Tesla was at, like 218.5 or something a little bit earlier, I called out puts. And of course, we had a slight jump after I mentioned the puts, but now you can see Tesla's down, right? Because the company just missed earnings and was on its way down to $200. So the fact that they brought it back up to 216, 218, in my opinion, they're basically handing you free money, because we know that it's going back to 200, in my opinion anyway. And now you can buy puts up here at 216. So, plan accordingly. Whatever you do with that information is entirely your own prerogative. But again, Shopify, I really don't even have to look at the numbers. We can quickly, but again, $5 billion for the year. Your company is not worth $65 billion. I'm sorry. That is just simple logic and common sense. Let's switch over here annually. We finally got back to positive cash flow, but we're trading 250 times cash flow, trading over 10.5 times sales. Again, the company, they went from $1 billion to $5.6 billion in annual revenue, but yet somehow they're still losing money. They're trading 9 times book value, which, as you see, it has been lower in the past at some times, and even recently was down at almost half of that. Enterprise value, we can't follow at all, because $168 billion. See what I mean? It makes me laugh so hard. But as we see here, return on assets, equity, invested capital have all recently turned negative. The gross margin, as you see, look at this, was up at 55 and just consistently decreasing with a small jump here. Now slightly back above 50, but again, not really where it was, about 10% lower than where it was. Operating margin was positive and then turned negative double digits. Now it's currently sitting at about minus 7%. The EBITDA, once again, earnings before interest, taxes, depreciation, amortization, as we see, was negative, climbed up to a little over 8.5% positive, and then immediately drops back down to negative double digits, now currently sitting at about minus 6%. And the net margin percentage, of course, the profitability, tracking the net income, as we see, going negative, jumps up significantly to positive, and then completely falls off a cliff, as we see, currently sitting at minus about 77.33%. So, I'm just seeing a lot of negativity. The asset turnover even was above 1 point and then consistently decreased. Look at this. Now we're seeing a slight rebound. But remember, this whole time that this was decreasing, the stock was increasing. So that's what I mean. The company had negatives on its back burner, but yet was being rewarded. And that's why stocks like that, I don't give a crap how much of a rally I miss, because I know that one day this thing is going to fall off a cliff. And we already know that stocks go up like escalators and they go down like elevators. So you always will most likely make more money and more returns betting on the downside as opposed to the upside. But going back, the history of the stock, as I mentioned, they've been doing very, very well. I'm not bashing the company. What I'm bashing is the current valuation. And we really need to bring it back down. As we see in 2020, cash was $2.7 billion, lost about $1 billion of that over the last couple of years, and also the debt has been slowly increasing, as we see, $150 million, and then COVID obviously added to it. Debt jumps up to $900 million, above $1 billion, now at $1.4 billion as of last year. So again, I can appreciate the fact the company has some negatives, but I am seeing a lot. I can appreciate the fact the company has some positives, but I am seeing a lot of negatives as well. I love the fact that these assets are significantly outweighing the liability. Again, assets minus liabilities gives us equity. And the more equity we have, the higher our book value goes. And this is very interesting as well, because as we see here, going back to the end of 21, assets about $13.3 billion. And now as we see, we're sub $10 billion. Liabilities, $2.21 billion. They bounced around. They went a little lower. They went a little higher. Now it's at $2.24 billion. So somehow they lost, $3.5 billion in assets while maintaining that same value of liabilities, which obviously is a bad sign because, again, assets minus liabilities gives us equity. And as you see, equity was $11 billion and basically overall has been slowly slipping over the last several quarters. Now equity's down to $7.5 billion. What does that mean? Well, what that means is the lower the equity, the lower the book value per share. As we see here, book value back at the tail end of 2021, almost $9, dips down to sub 7, gets as low as 6.5, slight rebound, now sub 6, right? So this stock that you may be confused is getting smacked up at 49.5 now. When it was at 70, I'm saying it's going to 40, potentially sub 40. And just remember, if the company goes out of business and has to close its doors tomorrow and liquidate everything in its name, you're going to get $5.82 a share. And we have seen much, much healthier financial companies trading at much, much lower price-to-book ratios, right? So that's what I'm saying. If this stock could be rewarded and trade at this extreme multiple above book value, then it has to be a rule across the board, right? And then what that means is all of these other companies that I've been talking about that are undervalued should be moving, 1,000%, 2,000% from its current levels. So that's the point I'm trying to make. There really is no rule. People try to find these exceptions to the rules, and when a stock is flying high, everyone wants to, bring up some random positive to try to justify the rally. But in the end, it really does all come back to fundamentals. And I know that I'm maybe pissing off a lot of technical analysts here, but at the end of the day, men lie, women lie, numbers do not lie. And when some of these negative numbers are increasing and the margin numbers are decreasing and turning back negative, or your revenue goes from $1 billion to almost $6 billion, but you're still not making money, like this, that's what I mean. These are big issues in my opinion. Right? If you and I were running this company, we would be having some trouble here. Our stock would not be getting rewarded. And that's basically the point I'm making. Now, over the last couple of quarters, the company has been coming in above expectations on the EPS side and on the revenue side, so I do have to give credit where credit's due. Look at that, going all the way back to 2015. On the annual side, has not missed a beat, hasn't missed a step. So the company, again, overall, doing very well. The problem is when they brought it up to 70, they shouldn't have, and they should have tapped the freaking thing up at like 40. But, they just kept going. But earnings are coming up and could really go either way. Like I said, in my opinion, the stock is tremendously overvalued, so no matter what they post, they should go lower. However, it does almost look like they're kind of stepping this down and potentially forming like this descending wedge to try to justify a pop back up into the mid-50s here after these earnings come out. However, again, as we see here, the stock, again, we had the rising wedge to help us out on the technical side, but the company came out I mean, look at that. Beating by over 4% on the revenue side, coming in with a huge surprise on the EPS side, but the stock went from 63 to 51. So that's why I'm saying this is something where, if you have the extra cash and you want to roll the dice and step in on this dip and try to catch a pop back and then a potential little rally after earnings, that is entirely your own prerogative. In my opinion, I would not buy shares of Shop with your money. And I stand by that analysis. Again, the stock was going up a couple of days after I originally called it out back in August or whenever the hell that was. And I know a lot of people may have not believed me. And that's what I mean. We immediately had the crash down into the low 50s. Then we had our fake pop. And it was right here, September 7th, I believe, when I re-mentioned in the Discord, you guys need to buy puts on this. And as you see, 64.5, and the stock immediately drops to 50. Now it's sub 50. So that's why I say sometimes you just have to work smarter. Don't work harder. But here on the daily, we'll look at stock charts quickly. We can see RSI sitting a little over 36.5 on the daily, so it definitely has a little bit lower to go. However, we did just break the bottom Bollinger Band, so we could have a potential bounce back up. But with the RSI still not at that 30 benchmark, and now it looks like the MACD has potentially crossed to the downside, we could potentially continue downward before we have a little bit of a relief rally back upward. This is actually a really bad sign looking at the weekly, because here the RSI is 42.25, right? So we could continue slipping. But more importantly, this week now, this stock has now pulled below the 50-day moving average for the first time since, the end of January of this year. So this is the first time in about 9 months that this stock is now below the 50-day moving average on the weekly, which of course is a bad sign. The MACD, as we see, the stock, in my opinion, was fake. So the MACD was flying, as we see here, for 18 months straight, which is just ridiculous. And now we're seeing the cross, and the MACD has been slipping for the last several months. But more importantly, as you see here, this candle looks like what is known as a bearish hammer. And what that means is we have, our little stem, and then we have our square with the stock at the bottom of that candle. And that forms a hammer to the downside. And that bearish hammer, obviously, it's in the name, is bearish, which means that we could potentially slide even lower. So this bottom Bollinger Band here of 47.12, I could definitely see the stock, dropping another 4% and change, and dropping down a few more points to 47 before it potentially tries to, bounce and try to get back to 50. I do think, in my opinion, that makes sense. But overall, again, this is why we have to just take a step back, look at our overall evaluation, look at the big picture, and like I said, a situation like this, as it's running up, it's at 58, it's at 61, just wait. Just be patient. Let them take it to the moon, right, to these ridiculously overinflated valuations, and then that's when you strike. That's when you strike. Because obviously the stock should be nowhere near 70, 60, or even 50. And now, over the last few months, the proof is in the pudding, and the stock is actually slipping even more as we speak. With the NASDAQ, which I mentioned, oh my God, absolutely killing it. This is another quick reminder, just completely throwing 18 things at you during this video, but I hope you're all still listening. This is another reminder, shout out to the crew in the Discord. I strongly advise you, in my opinion, to join the Discord server, link in the description of every video. I have been making some very decent call-outs here in the short term. I mentioned puts on QQQ earlier, and I mentioned I was red going into today, and as we see, today is red, and even earlier, we were looking at a potential bounce. Myself and one individual, we were talking privately, and I mentioned that we could see a rally here. So money was made on the upside. Then I said that the Dow is touching this. Where is it? Then I said the Dow has now ran up, and it was up like 100 plus points or something at this level. We hit this trend line, and I said, now is the time to buy puts. And as you see, that was roughly a 200-point drop in about the last 90 minutes, right? So this is what I'm saying. If you're in the Discord, right, you could have potentially jumped in puts here, but let's just say you didn't. But right around this time, and as we rose and broke this trend line, I knew that we had to buy puts. And as you see here, that was like a 140-point run right there. So you would have made money on the upside buying calls on the Dow ETF, DIA. And then, of course, on the flip side, I would have said to buy puts. And as you see, a 200-point swing, you would have made money on the put side. So just trading the Dow, you could have gone 2 for 2 today and made yourself some decent profits. And the only reason why you didn't is because you're not in the Discord. And, honestly, I'm going to end it there because we're making some great calls here. We seem to be on the right track. Our mind is in the right place. And I know I always say whatever you do with my information is entirely your own prerogative, because it is at the end of the day. It's your money. It's your call. You're going to do, whatever your gut is telling you, whatever your mind is telling you. But again, I always say I know what I know. And if I know something, I'm going to let you know. And that's all I can do. The rest is in your hands. But I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm, share the video, like the video, helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. I will do updates on the Dow, Shopify, Campbell's Soup, whatever the hell you guys want. Just do me a favor. Push the subscribe button. That is how you help me help you. But more importantly, moving forward, like I always say, I understand markets are rocky, they're volatile, we've been popping, we've been dropping hard. I understand that the outlook may be uncertain and you may be losing confidence, but I just want to say I hope everyone does well. I hope everyone makes a couple of dollars. I want you guys to stay confident, stay sharp, stay focused. Thanks for stopping by, and I'll catch you in the next one.